I thought that this growth stuff would get sorted out in 2 to 3 months, and now I'm worried it's 2 to 3 years. I think it's toxic. Toxic.
Hey guys, welcome back to Library of Wealth. Today we're checking out Chamath on the All In podcast, giving us a market update, as well as the changes that are happening in the economy. Chamath believes the Fed's printing, interest rate hikes, and inflation will all play major factors in the market's incremental growth, and so cost of capital is a crucial element to any investor in the current economic landscape. It is incredible how much value of the global market has been destroyed in the past few months alone, and the financial system is now in danger. Chamath believes the market is going to make a hard landing, and with the severe corrections recently, we'll see that sooner than later. The correlation between the stock market and the Fed money printer is becoming more evident, and with the current economic downturn, it looks eerily similar to the crash of '08. Let's check out this interview with Chamath as he talks about his investment direction and where the stock market is headed in the next few months. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
I think that there's still a lot of uncertainty in the world and in the markets. I would rather miss the first 10 or 15% of a rally once we're really done with this stuff than try to overcorrect and try to pick a bottom, just because I think that you could lose a lot of money. So I think the goal for this year is to stay resilient and in the game. And so having a bunch of cash on the sidelines ready to pound it in. Meanwhile, a portion of it collecting 5% is not such a bad thing while you wait for the bottom.
I just don't understand how the consumer isn't going to finally tap out in this economy. I mean, they have a mountain of personal debt, credit card debts at all-time highs. I think the average credit card rate hit 19.6% last week and is expected to rise even further. The mortgage rates are above 7% now, so forget about trying to buy a new home or sell your home. And your stock portfolio is down too, and now layoffs are starting to pile up. So I just don't understand how we're going to avoid a recession. And you saw, Kashkari saying that the Fed's going to keep raising 5.4% is his prediction. I don't understand how if rates are at 5.5%, that doesn't finally break the back of this economy.
Guys, what I was telling JCal is at the end of Q4, I did 5 deals, and 4 were pro ratas, 1 was a new deal. And they were all clean markups. So the 4 deals that other people put money into. And I was looking at them and I was trying to figure out, okay, what differentiates these things? And Freebird, to your point, these were super clean startups with very clean cap tables that had clear progress. And then conversely, I had 7 converts showed to me for companies whose valuations were anywhere between 3 and I would say 12 billion. And I did none of them. And not only did I do none of them, nobody else did any of them. And the problem was the real market clearing price was 80 to 90% down. And so I was like, what is going on here? So Freebird, to your point, I don't even think it's just cash intensive startups. I think it's like all growth companies are in a really bad place. I thought that this growth stuff would get sorted out in 2 to 3 months. And now I'm worried it's 2 to 3 years. I think it's toxic. Toxic.
What I think has happened and where I think the cutoff is when the implied market valuation of the company based on where public comps are trading is less than the total capital preference in the company, the total preferred stock. Wow. And there's so many companies now that raised 400 million at a 2 billion valuation, but the company is actually worth 300 million now based on public market comps. So they're worth less than their preference stack. So how do you sort through that mess with investors?
No, this is why I think all these converts are getting done.
That's where the rubber meets the road on all these deals. Yeah, that's right.
Who does the convert benefit? The convert benefits the VCs who want to maintain the illusory valuation that they had before. They do that to assuage the limited partner who gave them money, that the marks aren't as bad as they thought. But the people that really get screwed, as Jason said, are the common shareholders, because eventually those convert deals that do get done, those people will end up owning the company. The cap table gets completely flushed and reset, and the employees get wiped out.
Chamath believes the framework for the bottom of the market is being built right now, and in the next 30 days, we could see that come to fruition. Although Chamath is bullish on the stock market, he predicts the rally will likely be unsustainable.
Inflation, which people expect to fall off a cliff, doesn't fall off a cliff as fast or as meaningfully as people want. And 2022 was really the story of goods inflation. right? All these prices and all of these things went up because the input costs went up, and we all had to bear the implications of that. The pendulum is swinging very markedly away from capital and towards labor. And as the labor participation rate stays low and continues to go down, and also it's compounded by an unemployment rate that may go up, right? It's going to be harder and harder to get people to do the work you need at the company you have unless you pay them more. And if that gets exaggerated, then inflation will stay where it is.
We assume that rising rates and inflation would taper down consumer demand, meaning consumers buying goods and stuff. And that certainly hasn't happened. I'm in Vegas right now. I was in the car yesterday, and the driver grew up in Vegas. He's like, I've lived my whole life in Vegas. He's like, I've never seen a December like we just had. It was packed the entire month. He's like, normally in Vegas, it's dead up until Christmas, and then New Year's people come into town, but it's normally dead. He's like, I've never seen such a busy month. And I think we see this in the numbers. Consumers are still spending like it's 2021. They're still spending like interest rates are zero. As we talked about, consumer credit is skyrocketing, wall rates are skyrocketing. And so I think we're going to run into a real wall with respect to consumer credit in sometime this year, and you're going to see, as you guys know, this is such a complicated, interwoven market of assets that the way that this can be traded, there's a lot of different ways to trade it, but I think it's going to be, in general, consumers are not going to be able to meet their debt obligations, and it's going to be really ugly.
Could be mortgages, could be credit card debt. Defaults are coming.
Yeah, and I think the market has priced in a bunch of this stuff. Obviously, companies like Affirm and the what are they called? Buy now, pay later companies, but credit card companies, mortgages. There's a lot of assets that you can start to kind of pick apart. Where do you think this unravels first? What gets hit hardest? What's underpriced and overpriced? Probably a lot of good pair trading to do, as Chamath kind of loves to talk about, with respect to which of these are more likely or less likely to be sensitive to this dynamic. But I think it's going to be a pretty ugly scene. Consumers just have way too much debt relative to their earnings right now, and it's pretty nasty. You come out of 2021 when you had, it's not just stimulus checks, it was the low interest rate and easy credit availability everywhere. And it's just easy to jump into getting new stuff and cool stuff. And then when you get used to getting new stuff every week or every month, you kind of stick with it and you're like, I don't want to give it up just yet. Not just yet. And so it's hard to kind of step back from spending when you have a new type of lifestyle. And I think that's what's going on.
And probably the biggest asset class that is going to get pressured is going to be junk debt. And the reason is a bunch of these variable rate loans, when rates are at 5 and 6%, that all of a sudden are like 11, 12, 13, 14% coupons, a bunch of companies will have trouble meeting their debt obligations, and we'll have to restructure the debt or we'll have to file.
The following months will serve as a clear indication of what to expect from the stock, crypto, and capital markets, despite the fact that they may currently be driven by fear. The regular consumer will be the one most impacted by this recessionary environment, and the credit and housing market's financial corrections are another issue to watch out for. With the value of the dollar decreasing, it remains a challenge to plan and execute a winning strategy with startup companies when you have massive interest rate increases that directly affect your business. Many of the private companies that Chamath purchases have the cost basis analysis nailed down and have found unique ways to maneuver within the volatile market conditions we're seeing now. What do you guys think about Chamath's outlook for the current market, and how will this affect investor sentiment in the coming months? Comment down below. Guys, thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.